Welcome back and Happy New Year. This is the gold market review for the 4th of January. An interesting first session for the gold market in 2022 was observed on Monday as the price action seemed to captivate traders and market participants. As the movement had not gone unnoticed, this report will be aiming to bring out some important current market drivers for gold's price. At the same time, in this report, we will attempt to provide a more medium to long-term view on the aspects that can move the gold market. In addition, our weekly gold technical analysis will be presented in a manner that enables the majority of traders to identify important levels and price action scenarios. Enjoy the report. Gold performed its largest daily sell-off since late November on Monday. The movement took place during the early European afternoon as the market was crossing into the US session. This may imply that traders from around the world may have participated in this price movement. Gold lost approximately $25 during the downside, but regained some ground back and stabilized afterwards. At about the same time, the dollar index, which follows the greenbacks movement opposed to other major currencies, moved in the opposite direction and gained ground. This is a clear antagonistic movement between the USD and gold's price, which is in play most of the time. Some analysts have argued that the movements in the US bond yield market that were on the rise, along with some positive movement in the major US stock markets, had created the sell-off for gold. Our personal view is that the market's focus is mostly on the new variant at the moment. Some reports note that the new variant, even though very transmittable, may not be so severe as initially thought, while this view can also lead us to believe that the health systems in various countries around the world may not be overworked, as was previously observed during the Delta variant outbreak. In this case, some economic risk may be relieved, and traders may have decided to express this notion through a temporary but notable sell-off in the gold market. Moreover, according to the Wall Street Journal, factories in Europe and the US are currently seeing supply chain problems subside for the past months, which may also be a source of bearish interest for gold. Also, improved industrial output and manufacturing activities in China and Japan seem to complement the pre-mentioned statement. Looking forward, if the pandemic is to subside, then some bearish sentiment can overtake gold temporarily. We would advise traders to keep an eye on the Fed's approach in the following months, as its monetary policy, which is expected to change, can create serious price action in the gold market. If the Fed is actually going to impose rate hikes as suggested broadly, then the instrument that could benefit the most under these circumstances could be the US dollar. Thus, from our point of view, the following months can be rather eventful and vibrant for the gold market. In the following days, traders have a rather interesting and important economic calendar to work with. On the 5th of January, we get the FOMC meeting minutes as the Fed reviews its December 14th to 15th, 2021 policy meeting. On the 6th of January, we get the US international trade figure for November and the weekly initial jobless claims, along with the ISM non-manufacturing PMIs for December. A key event is released on Friday the 7th, with the US employment report for December being in the spotlight. Traders will be looking to comprehend the overall picture among the unemployment rate, the NFP figure, and the average earnings rate. Investors are advised to trade carefully, as this event has in the past created significant price movement across the financial markets. Moving now to our gold technical analysis, please note this is gold's 4-hour chart. Now, the precious metal continues to make its way higher in the most recent sessions, but has not in any case rebounded from its sell-off on Monday. The recent buying momentum is also confirmed with the RSI indicator, which seems to be ascending and has reached the 45 level so far. If the buying is extended, then we might see the metal reaching the R1 1815 resistance level, as this line was used mostly as a peak previously. Even higher, we note the R2 1830 that was the highest level reached by the metal on Monday since late November. At the top, our R3 1850 line remains a long-term target to the upside and can be used in case the metal is undertaken by significant bullish interest. In the scenario of a continuation of the recent sell-off, the S1 1795 level can be approached first, while a move below can make way for the S2 1785 support to be engaged. The S2 held its ground as a support during the pre-holiday season, while in the past it was used also as a resistance, making it very attractive. Our lowest level is currently noted as the S3 1765 line. The R3 and the S3 can both be used as levels for pending orders. As a conclusion, in our opinion, we tend to keep a bias for a sideways motion with the price action stretching between the R1 and the S1. A clear break above or below these two levels could signal a trend change. Thank you very much for your time and focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.